Impact Report, projected 30% decline in automotive construction and appliance industries by Q4 2024. Date, February 10, 2025. Overview. The automotive construction and appliance industries are projected to experience a 30% decline by Q4 2024. This downturn is attributed to post-tariff market adjustments and evolving international competitive dynamics. This report synthesizes insights from various industry analyses focusing on the automotive sector's outlook, challenges faced by construction and appliance sectors, and the chemical industry's context. Automotive industry outlook. Current sales trends. The automotive industry saw a substantial rebound in 2023, with global sales reaching approximately 91.7 million vehicles, a growth of 11.7% year-over-year YoY. However, projections for 2024 indicate a notable slowdown, with sales expected to increase only by 3.3%, reaching around 94.7 million vehicles. Key factors influencing this trend include rising interest rates, retraction of government subsidies for electric vehicles (EVs), and diminishing consumer confidence. Challenges for electric vehicles. While the EV sector continues to grow, it faces significant challenges, particularly from subsidy rollbacks and heightened competition from Chinese manufacturers. Chinese automakers are expected to expand aggressively into developing markets, particularly in Latin America and Africa, leveraging cost-effective supply chains to gain market share. Regional sales growth. Western Europe, leading with a projected 3.5% YoY growth. North America, anticipated to see a 3% increase. Asia Pacific, expected to lag slightly with a 2.9% growth. Latin America, forecasted to experience only a 1.7% increase in vehicle sales, indicating significant regional disparities. Construction and appliance industries. Market conditions. Similar to automotive, the construction and appliance sectors are facing a downturn, largely due to high inflation and increased interest rates, which are adversely affecting consumer demand. Despite potential recovery driven by government investments in infrastructure and clean energy, these industries are hindered by rising material costs and sluggish spending patterns. Sector-specific challenges. Construction, forecasted to face headwinds despite some recovery opportunities. High material costs and reduced consumer spending are significant challenges. Appliances, demand is also declining, influenced by the same economic pressures affecting construction. Chemical industry context. Broader trends. The chemical industry, which plays a critical role in supporting both the automotive and construction sectors, anticipates modest growth in 2025. After a decline in 2023, the sector is projected to grow at a rate of 3.5% in global production. Companies are focusing on cost reduction measures and innovation to remain competitive amid evolving market demands. Key dynamics influencing the chemical sector. 1. Economic uncertainty. Rising interest rates and inflation continue to dampen consumer spending and industrial demand across sectors. 2. Sustainability focus. Companies are increasingly prioritizing sustainability and innovation to meet regulatory pressures and changing consumer expectations. 3. Supply chain resilience. Ongoing geopolitical tensions create additional uncertainty, impacting supply chains globally. Common themes across industries. 1. Economic uncertainty. All industries are grappling with the impacts of macroeconomic conditions, particularly inflation and interest rates. 2. Shift towards sustainability. An increasing focus on sustainability is evident, with companies seeking innovative solutions to reduce emissions. 3. Supply chain challenges. The complexities of global supply chains remain a significant concern, exacerbated by geopolitical and economic factors. Differences in perspectives. While ABI research provides an automotive-specific outlook emphasizing consumer behavior and market dynamics, Deloitte offers a broader perspective on the chemical industry's strategic responses, highlighting the importance of cost efficiency and innovation. Timeline of industry events. 1. 2020 to 2022, significant supply chain disruptions and reduced demand caused by the COVID-19 pandemic. 2. 2023, a strong recovery in automotive sales reaching 91.7 million vehicles sold. 3. Q4 2024, industries projected to face a 30% decline due to ongoing economic pressures and tariff impacts. For 2025, moderate recovery anticipated in the chemical sector driven by innovation and a focus on sustainability. Conclusion. The anticipated decline across key industries reflects broader economic uncertainties and shifts in consumer preferences. The automotive sector's growth slowdown, coupled with construction and appliance industry challenges, underscores a critical need for strategic adaptations. Emphasizing sustainability and innovation will be essential for recovery as companies navigate these multifaceted challenges. References. 1. Deloitte Insights, 2025 Chemical Industry Outlook. 2. ABI Research, Automotive Industry Outlook 2024. The content presents a multifaceted analysis of the projected decline across the automotive, construction, and appliance industries, with a specific emphasis on the anticipated 30% drop by Q4 2024. The discussion incorporates several counterintuitive insights that challenge conventional expectations about industry trends, recovery timelines, and market dynamics. Below are the identified counterintuitive points drawn from the analysis. 1. Automotive recovery versus decline. While the automotive industry saw a robust recovery in 2023 with a significant sales increase 11.7% YoY, it is poised for a dramatic slowdown with only a 3.3% growth forecast for 2024. This stark contrast highlights the unpredictability of market dynamics. What appears to be a recovery can quickly shift to a decline due to external factors such as rising interest rates, subsidy rollbacks for EVs, and increasing competition from international manufacturers, especially from China. 2. High inflation impact. The construction and appliance sectors are currently suffering from high inflation and increased interest rates, which curtail consumer spending. However, there is an expectation of partial recovery in these sectors due to government investments in infrastructure and clean energy. This suggests that while inflation typically dampens demand, strategic government interventions can create opportunities for recovery, contradicting the expectation that economic downturns always lead to prolonged industry slumps. 3. Electric vehicle market dynamics. Despite the overall downturn projected for the automotive industry, the electric vehicle segment continues to grow, albeit at a slower pace than previously experienced. The decline in government subsidies is significant, yet it has not entirely stifled the EV market's growth. The situation illustrates that certain segments within a struggling industry can still thrive, particularly when they are supported by consumer demand and technological advancements, which is contrary to the typical narrative that all segments of a declining industry will uniformly suffer. 4. Chemical industry resilience. The chemical industry, which is closely tied to the automotive and construction sectors, is expected to grow modestly in 2025 despite a decline in 2023. Many might anticipate a uniform downturn across related industries, but the chemical sector's focus on innovation and sustainability is enabling it to navigate these challenges more adeptly. Companies within this sector are investing in decarbonization and efficiency measures, suggesting that a proactive approach can yield positive outcomes even in a declining market. 5. Supply chain resilience amid geopolitical tensions. The narrative suggests that geopolitical tensions and climate issues have disrupted supply chains. However, the analysis indicates that companies are leveraging these disruptions to enhance supply chain resilience and flexibility, instead of uniformly collapsing under pressure. Firms are adapting and transforming their operations to not only survive but to potentially thrive in a more complex international landscape. This counters the common belief that geopolitical instability leads to straightforward negative outcomes for all businesses. 6. Consumer behavior paradox. The analysis highlights that despite rising interest rates and inflation, certain markets, specifically in Western Europe and North America, experienced higher vehicle sales growth than in Asia-Pacific and Latin America. This counterintuitive outcome suggests that affluent consumers may continue to spend on big-ticket items during economic uncertainty, defying the expectation that financial constraints uniformly suppress luxury spending. 7. Investment in sustainability. The expected slowdown in capital expenditures for the chemical industry due to high interest rates is paradoxical. Companies are still prioritizing sustainability and innovation, suggesting that businesses may be willing to invest in long-term goals even when faced with short-term economic pressures. This challenges the assumption that companies will always pull back on investments in times of financial strain. 8. Emerging markets and competitive dynamics. The narrative that emerging markets will uniformly lag behind developed ones is contradicted by the anticipated growth in vehicle sales in regions like Latin America and Africa, where Chinese manufacturers are expected to play a significant role. This indicates that competitive dynamics are shifting and companies can find lucrative opportunities in markets previously considered less attractive or stable. 9. Role of digital transformation. The adoption of digital technologies for supply chain management and customer engagement is expected to drive efficiencies and competitive advantages. This suggests that companies can overcome traditional challenges through innovative approaches, challenging the notion that industry decline is solely a result of external economic factors. In summary, the analysis reveals several counterintuitive insights that challenge conventional wisdom regarding the trajectories of the automotive, construction, and appliance industries as well as the broader chemical sector. The interplay of strategic investments, consumer behavior, and market dynamics illustrates the complexity of industry recovery and adaptation in the face of significant challenges. The projected 30% decline in the automotive, construction, and appliance industries by Q4 2024 is a critical concern that has far-reaching implications, yet several key aspects of this situation may be overlooked by many stakeholders. Below, we will identify these important content areas and explain their significance in the broader context of industry dynamics and economic health. 1. Impact of tariffs and trade policies. Many reports emphasize the economic implications of rising interest rates and inflation. But the role of tariffs and trade policies is often glossed over. Tariffs can significantly alter competitive dynamics, particularly in the automotive and appliance industries where supply chains are increasingly global. Significance: tariffs imposed on imported goods can lead to increased costs for manufacturers who rely on imported components. This financial pressure could further diminish consumer confidence and spending, exacerbating the projected decline. Understanding the intricate web of tariffs and trade policies is vital for companies to navigate their international operations effectively and adjust pricing strategies and supply chains accordingly. 2. Emerging market dynamics. The report mentions the competitive expansion of Chinese manufacturers into developing markets, but the specific dynamics of these markets are often underanalyzed. Countries in Latin America and Africa are experiencing shifts in consumer behavior with increasing demand for affordable vehicles and appliances. Significance: as these markets grow, they present opportunities for companies that can innovate and adapt their offerings to meet local needs. Ignoring these emerging trends could result in missed opportunities for growth or partnerships, as established companies might find themselves outmaneuvered by nimble competitors who better understand these markets. 3. Consumer confidence and behavior changes. While economic indicators such as inflation and interest rates are frequently discussed, the nuances of consumer behavior, specifically post-pandemic shifts, are often overlooked. The pandemic has altered consumer priorities with a greater emphasis on sustainability, digital engagement, and value for money. Significance: companies that fail to acknowledge these changes may struggle to attract customers in a recovering market. Developing strategies that resonate with evolving consumer preferences such as sustainability initiatives or enhanced digital purchasing experiences will be crucial for maintaining market share. 4. Role of sustainability in market recovery. The emphasis on sustainability across industries is highlighted in the report. Yet the specific implications for recovery strategies are sometimes not fully explored. Companies that prioritize sustainability not only align with consumer preferences but also prepare for future regulatory pressures. Significance: firms that integrate sustainability into their business models may gain a competitive advantage as consumers increasingly favor environmentally responsible products. Additionally, as governments implement stricter environmental regulations, companies that are proactive in sustainability will be better positioned to avoid penalties and capitalize on green incentives. 5. Supply chain resilience and adaptation. The ongoing challenges in global supply chains are mentioned briefly, but the significance of building resilience is often understated. The pandemic exposed vulnerabilities in supply chains, and companies must now consider diversification and flexibility in sourcing and logistics. Significance: in a landscape characterized by geopolitical tensions and climate risks, companies that enhance their supply chain resilience through diversification or local sourcing may better withstand shocks. This resilience will not only improve operational efficiency but also bolster customer trust by ensuring consistent product availability. 6. Sector-specific strategic responses. While the report discusses the overall economic downturn, the strategic responses of different sectors, particularly the chemical industry, deserve more attention. The chemical sector is integral to both the automotive and construction industries, and its recovery strategies, focused on innovation and cost efficiency, are critical. Significance: companies in the automotive and construction sectors need to monitor the chemical industry's adaptations, as they may influence material availability, pricing, and innovation directions. Collaborating with chemical manufacturers on sustainable materials could provide a competitive edge. 7. Long-term trends versus short-term recovery. The anticipated decline in these industries is framed within a short-term context. But there is a lack of analysis regarding longer-term trends. For instance, the shift towards electric vehicles and smart appliances is a significant trend that could redefine market landscapes. Significance: companies that only focus on immediate recovery may miss out on investing in transformative technologies that could dictate future industry leadership. Preparing for long-term shifts such as the transition to EVs and smart technologies will be essential for sustained growth and competitiveness. 8. Innovation as a driver for recovery. While innovation is mentioned within the context of the chemical industry, its broader implications for the automotive and construction sectors could be emphasized more. Innovation driven by technological advancements and changing consumer demands could serve as a catalyst for recovery. Significance: companies that invest in R&D and embrace digital transformation may not only survive the downturn but thrive by offering new solutions that meet emerging consumer needs. This focus on innovation can differentiate market leaders from laggards, particularly in industries facing significant transformation. Conclusion: the projected decline in the automotive, construction, and appliance industries by Q4 2024 is a complex issue that encompasses various factors, many of which are often overlooked. By understanding the implications of tariffs, evolving consumer behavior, sustainability, supply chain resilience, sector-specific strategies, and the importance of innovation, stakeholders can better prepare for the challenges ahead and position themselves for future success in an uncertain economic environment. Recognizing these nuances will be vital for companies as they navigate the shifting landscape of global markets. 1. Economic uncertainty and its impact on demand. The projected 30% decline in the automotive, construction, and appliance industries by Q4 2024 is heavily influenced by macroeconomic conditions. Rising interest rates and inflation are leading to reduced consumer spending and industrial demand, creating a challenging environment for these sectors. This point is crucial for understanding the broader economic implications and the interconnectedness of various industries under stress. 2. Shift towards sustainability. Across the automotive, construction, and chemical industries, there is a notable trend towards sustainability. Companies are investing in decarbonization and innovations to meet regulatory pressures and changing consumer preferences. This focus on sustainability may help industries navigate declines by aligning with future market demands, making it a critical area for analysis. 3. Supply chain resilience. The ongoing geopolitical tensions and supply chain disruptions are significant concerns for the automotive and construction sectors. Companies are increasingly focused on building resilience through diversification, digital transformation, and strategic partnerships. Understanding how supply chain dynamics are shifting can provide insights into how companies might adapt to future challenges. For innovation and recovery timelines, the timelines for recovery in these industries, particularly in the chemical sector, hinge on innovation and strategic responses to market pressures. Companies are prioritizing investments in R&D and adopting new technologies to remain competitive. This point emphasizes the role of innovation in recovery and growth, making it a vital aspect of the discussion on future industry trajectories. 1. The Great Depression 1929 to 1939. The Great Depression was a severe worldwide economic downturn that began in the United States after the stock market crash of October 1929. It resulted in a significant decline in industrial production and employment, with the automotive and construction industries among the hardest hit. The economic collapse led to a drastic reduction in consumer spending, resulting in a decline in demand for automobiles and residential construction. Recovery was slow and uneven, driven by various factors including government intervention through the New Deal programs and the onset of World War II, which boosted industrial production and employment. 2. The oil crisis of the 1970s. The oil crises of the 1970s, particularly the 1973 oil embargo and the 1979 energy crisis, had a profound impact on the global economy, leading to a recession in many countries. The automotive industry was significantly affected as rising oil prices led to increased costs for manufacturers and decreased consumer demand for larger vehicles, particularly in the United States. This period also saw a shift towards fuel-efficient vehicles and a greater emphasis on energy conservation. Recovery was facilitated by technological innovations and a gradual adaptation by automakers to changing consumer preferences. 3. The 2008 financial crisis. The global financial crisis of 2008 triggered a severe recession that impacted multiple industries, including automotive, construction, and appliances. The housing market collapse resulted in a sharp decline in construction activity, while the automotive industry faced plummeting sales, leading to bankruptcies and government bailouts for major automakers like General Motors and Chrysler. Recovery post-crisis was slow, characterized by significant changes in consumer behavior, regulatory reforms, and shifts towards more fuel-efficient and environmentally friendly vehicles. The crisis highlighted vulnerabilities in the financial system and led to major economic and regulatory changes. The projected decline of 30% in the automotive, construction, and appliance industries by Q4 2024 reflects significant shifts in the international competitive landscape, primarily driven by post-tariff adjustments and macroeconomic factors. This analysis outlines the expected trajectories for these sectors and their implications for future growth. Automotive industry outlook. The automotive industry has seen a remarkable recovery in 2023, with global sales reaching approximately 91.7 million vehicles, marking an 11.7% increase from the previous year. However, this growth is anticipated to decelerate significantly, with projections of only 3.3% growth in 2024, resulting in around 94.7 million vehicles sold. Key challenges contributing to this slowdown include: 1. Rising interest rates. Increased borrowing costs are expected to dampen consumer spending on vehicle purchases. 2. decreased consumer confidence. A retraction of government subsidies for electric vehicles (EVs) has negatively impacted consumer sentiment. 3. Competitive landscape. Chinese manufacturers are anticipated to strengthen their foothold in developing markets, particularly in Latin America and Africa, further intensifying competition. In the EV sector, despite a temporary setback due to subsidy rollbacks, sales are projected to grow from 13.5 million in 2023 to 17.1 million in 2024, highlighting the ongoing transition to electric mobility. Construction and appliance industries. Similar to the automotive sector, the construction and appliance industries are poised for a downturn due to increased material costs, inflation, and reduced consumer spending. While government investments in infrastructure may offer some relief, the overall outlook remains grim. 1. Inflation pressures. High inflation rates are suppressing demand across both sectors. 2. Interest rates. Elevated borrowing costs are stifling new projects and consumer purchases of appliances. 3. Material costs. Escalating costs of raw materials continue to hinder profit margins and project viability. Chemical industry context. The chemical industry, which serves as a backbone for automotive and construction sectors, is expected to exhibit modest growth, following a decline in 2023. Projections indicate a 3.5% growth in global chemical production in 2025. Key themes impacting the chemical sector include: 1. Cost reduction initiatives. Companies are prioritizing operational efficiencies and sustainability to enhance competitiveness. 2. Innovation focus. There is a significant push towards sustainability, including investments in decarbonization and innovative chemical processes. 3. Supply chain resilience. Ongoing geopolitical tensions and market fluctuations necessitate robust supply chain strategies. Future recovery timelines. 1. Short-term 2024. Expect continued declines across automotive, construction, and appliances as macroeconomic pressures persist. Recovery is unlikely until government policies stabilize and consumer confidence rebounds. 2. Medium-term 2025 to 2026. A gradual recovery is anticipated as interest rates stabilize and inflationary pressures ease. Increased government spending on infrastructure and clean energy initiatives may provide a stimulus for the construction sector. 3. Long-term 2027 and beyond, as the global economy adapts to new norms post-tariff and inflation. Industries are expected to realign around sustainability and innovation. This shift may lead to a balanced growth trajectory, particularly in sectors aligned with emerging technologies and consumer preferences. Conclusion. The next few years will be pivotal for the automotive, construction, and appliance industries as they navigate a complex landscape of economic challenges and competitive pressures. Strategic adaptations focusing on sustainability, innovation, and resilience will be critical for recovery. Companies that successfully leverage these themes are likely to emerge stronger as the global economy stabilizes and evolves in response to changing consumer demands and regulatory environments.